Bill, what's it like to write with that language of a remarkable and surreal Fed economics? Are you getting criticism from inside the Fed?
I'm sure it doesn't make people there happy, but the reality is I got to call it like I see it. And what I see right now is a Federal Reserve that has a very benign forecast relative to what's actually happening on inflation. If you look at their forecast that they published at the December FOMC meeting, they have inflation melting away to 2.1% in 2024, even though they don't take monetary policy to a tight setting. The end of 2024, the federal funds rate is 2.1%, below what they think is neutral. So how does the inflation magically disappear if the Federal Reserve is actually not making monetary policy tight? That's the question I want to raise in this piece.
Bill Dudley, Alan Greenspan in 1998 at least, talking about the measurement and measured and the idea of a graduation, a step-by-step approach. Alan Blinder in an essay in 2005 said the Greenspan standard is suspect. Are we going back to Arthur Burns and the pipe smoke where we're going to lose quarter point measured and start to see some real jumps?
I think they're going to go fairly slow at first, but because they think that the inflation pressures that we're seeing right now are going to subside as we go through the first half of the year. But the real new information is the tightness of the labor market and the fact that that tightness of the labor market is resulting in higher wages above what's consistent with 2% inflation. So I think even if the initial impulse of inflation turns out to be transitory, they now have a problem because the labor market's sufficiently tight that wages are going to continue to accelerate.
Bill, in your piece, you reiterate your call for 3 to 4% as the potential end rate for the Fed funds figure. I'm struck by the fact that you include the idea of an end rate for inflation at 2.5 to 3%, which is actually a commonplace suggestion. What happens to risk markets if the Fed funds rate gets to 3 or 4%? Do you think that this economy can sustain that?
Well, I think that's the fundamental question. In 2004, 2006, the economy sustained the Fed taking the federal funds rate from 1% to 5.25%. Yet in 2016 to 19, the economy didn't do so well with the Fed taking the federal funds rate to, up a little bit over 2%. So I think that's the fundamental question. How do markets react to Fed tightening? I think that right now, this idea, though, that the Fed is a small amount of tightening is going to cause markets to go down precipitously, and that's going to cause the Fed to stop. I don't think that's the most likely outcome.
If you think that inflation subsiding at 2.5 to 3% would result in what could be a crippling Fed funds rate, then are you saying that we need an inflation rate below 2.5% to have an economy that is sustainable over the next decade?
Well, I don't think a 3 to 4% federal funds rate is crippling in any way. It's only unusually high relative to the last 10 years. It's actually pretty low relative to the last 30 or 40 years. So I think the economy can do just fine with a federal funds rate in that range. I think what markets are really mispricing is the fact that the Fed is actually going to have to move to a tight monetary policy setting at some point. The Fed has turned more hawkish in the very near term, so a lot more rate hikes are being priced in 2022. But the terminal federal funds rate the market's expecting is still very low, only around 2% or so.
Bill, what's important here, and I think to summarize the message, you think for inflation to come lower, the Fed needs to engineer tighter financial conditions. Bill, I'm trying to understand from your standpoint, where do you think that tightness begins? Where do you think it is? 1.5%, 2%, 2.5%? When does it start to become restrictive and where we can sit here and say the Fed is now tightening?
Well, I think it's when the markets start to price in more tightening than what they've priced in at this point in time. I mean, if the Fed just delivers what's priced in today, I don't think markets react very much because it's already priced in. So the Federal Reserve essentially has to go further than what the market anticipates for the markets to react. I think what will happen is first bond yields will go up further. We'll probably see bond yields in the 2.5%, 3% range. And once we have higher 10-year Treasury note yields, that will start to weigh on the stock market a little bit more. And other, risk assets like, say, cryptocurrencies, for example.
But what you just said, though, the original piece of this is that you think when that happens, the Fed doesn't back off. It's not the old playbook.
Well, the Fed has to do its job at the end of the day. I mean, if you try to defer the fight against inflation, all you do is get more inflation. So it's not like, trying to be a nice guy gets you to a better place. We sort of saw that mistake in the early 1970s. So I think the Federal Reserve at the end of the day will do its job. I think it's just slow, to realize right now the consequences of the tight labor market, which they've engineered at this point.
Bill Dudley, I want to go back to Dudley McKelvey, Goldman Sachs. There's not a moment to lose. That's what I hear in your essay this morning. It's like, okay, guys, let's get it going. The Taylor rule is described on the Bloomberg is stunning. It's something you and I never would have envisioned. John Taylor of Stanford never would have envisioned where we are. Which moves quicker, the Taylor rule coming down with all its moving parts, or does the Fed move up at a greater speed?
Well, I don't think the Taylor rule is really that relevant to what the Fed is doing right now. I mean, if you listen to Chair Powell, he talks about the importance of financial conditions. And I think that's the key issue. The financial conditions today are extremely accommodative. To slow the economy down, the Fed needs to make financial conditions less accommodative. How do they do that? They raise short-term rates. They raise short-term rates more and faster than what markets expect.
Bill, how does balance sheet reduction play into this as well, from your standpoint?
Well, it's interesting that there seems to be a growing sentiment that the balance sheet reduction is going to happen sooner than last time, not just in time, but also in terms of the level of interest rates where the Fed is going to start the balance sheet normalization process. Mary Daly last week talked about getting going, after a couple of rate hikes. I find that a little bit surprising, given that the Fed officials have also said that they want the federal funds rate to be the primary tool of monetary policy. Well, if you want the federal funds rate to be the primary tool of monetary policy, you need to get the federal funds rate up so it can actually react to adverse shocks in the economy so you can push it back down. So I think the case for being a little bit more patient with the balance sheet is still pretty strong, but it certainly looks like, judging from Fed officials' commentary, that they're going to go a little bit faster this time, not just in time, but also in terms of what level of interest rates we have to get to before they start to normalize the balance sheet.
What's your sense of how much they should raise rates this year?
I think they should go faster than what's priced into the market. I mean, obviously, it's going to depend a bit on how the economy evolves. But my best guess is, that they need to do at least 4 or 5 rate hikes this year. And it wouldn't strike me at all if we get into an every meeting kind of cycle at some point.
Bill, what went wrong for this Federal Reserve? Let's finish there. What went wrong?
Well, I think there was, essentially 4 mistakes that were made. Number one, the way they operationalized the 2% average inflation targeting regime by saying that they're not going to even begin to lift off until they've satisfied the goals of inflation at 2%, expected to be above 2% in the future, and at full employment. So that means the starting point for monetary policy liftoff is the economy is already overheating. Number two, I think they were wrong about the labor market. I think they were surprised by how fast the labor market tightened. The participation rate has not come back to the degree that they were expecting. Third, they were surprised, I think, about inflation. The transitory story hasn't played out very well. I think a lot of the inflation pressures we're seeing are transitory, but that's lasting longer for a lot longer at a lot higher rate than they anticipated. And then finally, I think they were a little bit too concerned about worrying about a taper tantrum. So I think they were a little bit too gentle in terms of their communication to financial markets because they were worried that was going to provoke a sell-off in the bond market. And I think, in fact, the problem right now is that the markets aren't taking them seriously enough.